All right, good afternoon, everybody. It is Thursday. It is TGIFE. Thank God it's Friday Eve. How is everybody doing? Let me know in the chat. There we go. Gene, you have that fired up every day right at the start, don't you? Love it. Love it. Everybody else besides Gene can hear me and see the screen all right? Wonderful. Yes, Gene, absolutely. I appreciate it. Dave, thank you. Awesome. We are going to talk about straddles and strangles. All the eco data we've gotten this week have been kind of right in line. We haven't seen anything that has rocked the market at all. So, we have to just keep that all in check. Market is SPOOs are at their high of the day right now. They're up 25 points. And let's see, the NASDAQ right now is up 27 points. The Dow is actually up 200, which is a massive move considering, again, the UNH, not just our UNH position, but United Healthcare being down. It's off its lows, but it was down another 15%. It's down 12% right now. So if everybody could possibly subscribe, like, hit, smash, all that good stuff right now. And let's get into it. Okay, straddles and strangles. Which is better? What are they? Which is better? Let me ask you guys before we go into it. If you trade them, which is better? Would you rather trade a strangle or a straddle? Thank you, Dave. Smash, smash, smash. What would you rather do here? Depends on the situation. That is the perfect answer. Hey, Fred. That is the perfect answer. Strangles are definitely cheaper. But let's talk about both. Okay? So what's the difference between straddles and strangles? Okay? They are both designed to honestly help speculate on volatility. Okay? Both, whether they're long or short, okay, are going to work or not work depending on if there is a big move in the stock. Okay, with either strategy, we don't know which way the market's going to swing. So what we are looking for, if we are long, meaning we own either of these, we're looking for the stock to move big in either direction. Okay, doesn't matter which direction. Now, if we're short them, we want what? If we have sold a straddle or a strangle, now what? What do we want to happen? Well, it's no, not a bear market. Not at all, Gene. Not a bear market. Range bound. Exactly, Kevin. If we sell them, that means we're going to have short strikes, right? We always want stock to go to the short strikes. So anywhere in between the short strikes here would be great for a short strangle or straddle. And if we are long one of them, we want this thing to move all the way out to the short strikes. Okay, so you can review this later, and I'm going to go through each piece of this right now, but this is a breakdown just summarized on one page here between a straddle and a strangle. So straddles, we're looking at the same strike price and expiration date, call and put. Okay, strangle, same expiration date, but different call and put strikes. Typically, when we're trading a strangle, we're looking at out of the money puts and out of the money calls. Okay, so if you think about it, on a straddle, since it's at the money, that's always going to cost more than a strangle, which are out of the money. Does that make sense? And that kind of goes right into this point right here. that if you're buying a straddle, it's going to cost more than buying a strangle. If you're selling, you're going to receive more than on a strangle. Okay, so this is what a long strangle P&L would look like. And I'll go to a live position right now. In fact, somebody just give me a stock you want to look at, and we'll create a long strangle and you can see what the P&L looks like. First stock I see up there we'll go to. Palantir it is, Gene. Okay, so right now, Palantir is trading $129. If we were going to put on a long strangle, okay, a long strangle, that would mean you're looking for the stock to just move in either direction big away from 129. So you might put on, let's say, the 120 put and the 140 call. Okay, so your risk chart is going to look like this. Let's put this out towards expiration. Okay, here is your risk chart. And what do you see here? You can see we don't want the stock to stay put. We don't want it to stay in a tight range. That's where we would lose the premium that we paid for this. But the bigger the move either to the downside or to the upside, the more we're going to make because we own an out of the money call and we own an out of the money put. Okay, so the loss on a long strangle is if we just stay right here. Does everybody see this and understand that? Okay, now a short strangle, which we don't sell short strangles here other than when we have a strangle swap position, when we're selling a strangle against buying another one. We just don't ever have the short strangle here because there is unlimited loss potential. So if we do the same Palantir, but now we sell each of these contracts, you're going to see the opposite position. Okay, and here you will see that in fact we want the stock to remain range bound because here now is all of our profit if we stay up here. But if we do get that big move to the downside, we have unlimited losses down to the stock being zero because we're short a put. On the upside, we do have theoretically unlimited loss potential because we're short a call. So we would never sell this position in and of itself naked. We do, like we have in take two right now, we do have a short strangle position, but that is as a hedge against a long strangle we have a week out. So does everybody understand this P&L graph, which is same thing as what we're seeing right here? And the max gain that you could ever make on a short strangle is just like what the max gain would be on any sort of credit spread that we normally do, and that would be the amount that you collect, the premium you collect. Okay, now let's compare that to a straddle. Okay, let's compare that to a straddle. Whereas the strangle had option prices that were further away, out of the money, less delta, less gamma. A straddle, we're talking about right at the money. So you would use a straddle if you're really, really expecting a big move. Now, There are times to use them and times not to use them, maybe. What does the pricing, actually of either a strangle or a straddle, but specifically for a straddle, what is the pricing really, what is it affected by? What is going to affect the pricing here for both straddles and strangles? Yeah, vol, exactly, implied vol. Bottom line, if implied vol is cheap, the price of your straddle is or strangle is going to be cheaper. If it's expensive, it's going to be, if IV is expensive, it's going to increase the price of the position. And what is so important about that is, and let's look at a live one here. I'm going to go back to Palantir, but we're going to look at now a straddle instead of a strangle. Okay, this 129 strike straddle that expires next week. So this is buying both a call and a put. Would cost us about $9.50. So what that tells us is, with the stock 129, we need the stock next Friday at expiration, to be either 119.50 or lower, or 138.5 or higher to be profitable. Okay, now what is so coincidental about looking at a straddle and at the money straddle? Yeah, that is also our expected move. That is also our expected move. Okay, so let's look in this case of this straddle here. Let's look to see if vol is expensive or cheap and how a change in vol could affect this. So right now, here is a chart in Palantir. Here's a 1-year chart of implied volatility. And though it's not all the way down here, vol is here right now, I'd say it's really cheap. I'd say vol is really, really cheap. If I was going to choose, someone said to me, you can either buy or sell this straddle. What do you want to do? I'm going to buy it. I'd be a buyer of this. Kevin, what part were you lost? Oh, sorry, fast on the math. I thought you said lost on the math. Sorry about that. I'd be a buyer. But let's see how a change in the implied volatility affects the price of this straddle. So right now in Palantir, we're right at about a 60% implied volatility. Okay. And we know that at a 60% implied volatility, which is pretty cheap, that straddle was about $9.50. What if this was a 70% implied volatility instead? It added on basically $1.25 or so to the price of that straddle. Now, if I buy that, now I got to get an extra $1.25 on either side to break even. Now I'm looking at 118.5 to get to my break even on the downside, and 139.5 to get to my break even on the upside. So if you are going to put on a long straddle or long strangle position, which you would do if you are expecting a big move in a stock in either direction, you really need to look at the implied volatility to make sure that you're buying it when vol is cheap. Because if you buy a strangle or a straddle when vol is really expensive, you can get a big move in the stock, which is what you want. But we know that if that vol crush happens, you can still get really hurt. Does that make sense to everybody? All right, we're not far along. We got a lot more to go, but let's get this out here today. Word of the day. Yeah, it was either going to be strangle or straddle, and strangle kind of has this connotation that not so good. So, in fact, I've never watched The Sopranos before ever, so I just started it a few nights ago with my wife. Season 1, episode 1. There was a strangulation. So we're going to go with straddle for our word of the day here. Okay, let's get that in here. All right, we'll come back to that. Well, Gene, going into earnings, when you're expecting a big move, sure, a straddle is a play that you could do for a big move. But also, what is volatility going into earnings? What is implied volatility like? We know that it is jacked up, right? We know that it is going to come crashing down. So we have to take that into account. Okay? You can go. You have to take that into account. Which, rather than just trading outright straddles or strangles, that's why I like to trade strangle swaps. I typically don't even touch straddles, but that's why I like to trade strangle swaps, because what we're doing is basically pricing the implied volatility of one set of options versus another. But let's break these down a little bit here. So again, a straddle. Straddle is a call and a put, same strike, same expiration date. Okay. And like we just looked at in Palantir, but this is a different example here. Let's say in this example, what I have on the screen right here, okay, $50 strike price, call and the put, each trade $3. So the straddle's $6. Okay, that's a 12% move in the stock that you would need at expiration to make money. Okay, a long straddle, the loss is what you pay for the position. That's it. Okay, can't lose more than what you pay for your call and put premiums. Your profits on a long straddle, well, on the downside, it would be whatever the stock price move is to zero, less what you paid for your straddle. On the upside, unlimited, theoretically, because a stock can just keep going and going and going. So unlimited less what you pay for your straddle. And as we talked about briefly, a straddle is always going to be more expensive than a strangle because the delta is higher, gamma is higher, you're right at the money versus out of the money. Short straddle. A lot of traders love selling premium. And I would do this again when volatility is really, really expensive, but not without buying something against it. I don't ever want to have those naked options, because even though you're collecting a lot of premium, the risk is unlimited. To the downside, a stock can only go to zero, so you know what your risk is there. But on the upside, just like if you were long a straddle, you could make theoretically unlimited amount. You can lose unlimited amount on the upside. And then the most you can make from a short straddle is what you sold it for, the premium that you collected. Okay, now a strangle, as we talked about, same principle, but instead of the at the monies, we're buying an out of the money call, out of the money put. So in this same example here that we just went through on the screen for straddle, say the stock was $50, rather than buying the 50 call and 50 put, maybe here you're buying the 55 call and the 45 put out of the money. It's going to be cheaper. You need less of a move to make money. Okay. Long strangle, your loss, what you pay for the options. Same thing as in a straddle, same thing as in any debit trade. Can't lose more than what you pay. Your potential gains, really, same thing as the straddle. You can make money all the way down to zero on the downside. You can make money theoretically unlimited on the upside. And the cost is less than a straddle because the options are out of the money. Short strangle, again, I don't ever want to be short a strangle by itself unless I'm long something against it. My losses are unlimited. Stock can go to zero, so I know what the loss could be down there, but theoretically, stocks can keep going on the upside. That's it. My profits are limited to the amount of premium I have collected. Okay, let's put this up there again, and then let's go through a real example. We already did one on Palantir. Somebody throw out another stock you want to look at here. Okay, let me get that up on the screen. Not going to do Foot Locker, Stephen, because now with that takeover, you're going to see really, really odd option prices. So I'm going to put up Coin, which obviously has a really big move today. There's a lot of move there. Stock's down 8% today. So here is, let's look at next week's options. Okay, stock is at 240. You want to look at a straddle or a strangle first? Well, Dave, you have in a butterfly or an iron condor, you know what your losses could possibly be because you have the same amount of long and short options. So they equal out. In a straddle or a strangle, if you're short one, you have naked options, which gives you that unlimited potential loss. Typically, you can make more, but you have that unlimited potential loss. Okay, so with the stock it's just rallied for $4 while we're speaking. So we are live here. So let's look at the stock trading 242.5. How about that? Okay. Let's say we want to buy the 220 put and the 265 call for next week. That would cost us about $6.25. Okay. So that would take us to 213.75 on the downside, 271.25 on the upside, where that would be our break even at the end of next week, expiration. Dave, some people want to just sell a lot of premium and they're willing to absorb that risk. I'm not. You obviously get more premium collected if you're selling naked options, not covering them, turning them into a spread. That's not something I want to do. Okay, so here, put this out to next week. And here is what that risk graph looks like. Whoops. Right there. Okay, and so if we don't get to those points we just talked about, those break-even points, that's a loss. And that's a loss of whatever we pay. That would be $6.25. Now it's pricing it at $6.70, but you can see that right in there. And then your break-evens are right at those areas we talked about. And then unlimited profit potential here, profits down to zero here. Okay. So what you will also see here when we compare the two graphs is the strangle is more, it's not quite V-shaped. It's a little bit more U-shaped. If there's a U and a half, right, between U and V, that graph, okay, on a strangle is like that. Now let's compare that to the at-the-money straddle. Okay, the at-the-money straddle, that's going to cost us $21. So about 3 or 3.5 times as much. Okay. Now, you're going to have a break even basically at 224 or 266. So much further inside than the strangle was, because even though we're paying more, the strikes we're starting from are right here rather than starting at those out of the money strikes. So if I look at the P&L on this, it is definitely more of a V. You don't have as rounded a bottom as you do with a strangle. You have a steeper loss here because you're paying more, but you also have quicker gains because those break evens are tighter in. So that's really the difference between a straddle and a strangle. Again, I would caution against selling a naked straddle or a strangle. They can be really effective tools. You would rather buy a straddle or a strangle when volatility is really cheap. Okay, last call here, guys. Last call. Get those entries in for the wheel, folks. All right, Sarunas straddle. Is that like a supersonic Superman straddle? Sarunas straddle. I like that. Maybe we'll name. Maybe we'll name a new position. The Sarunas straddle. There we go. A new financial instrument. Yes. While we're waiting for the wheel to come up here, guys, smash, like, subscribe. John, the break even is tighter on a straddle. but it costs more to get there. Let's so here's a strangle. Okay, this would be a strangle, so you can see wider area of potential loss. And a straddle is like this, a V. Okay, and again, we always say, right, if you're going to get something, you're going to give something. So in this case with a straddle, you're getting a tighter break even. So the stock doesn't need to move, as far, but it's costing you more. Okay. All right. I think we got our wheel. There we go. We are good to go. I'm going to leave this up here. Here is our wheel today. Yeah, we're getting filled up, guys. We're getting filled up. And as a highlight for tomorrow, yesterday I got the suggestion for diagonals. So this should say 515 up there, but this is not yesterday's wheel. This is today's. Right, Danny? That is today's wheel, even though it says 514. Yes, it is. Okay, great. Let's go. Hey, Gene, Robert, Kevin, Gene. I know you are here. I know you are here because you just commented. John, you're very welcome. All right, Gene, you know what to do, right? Send me an email there. Swag size. I know you've won before. Tell me what you have so we don't duplicate it. Swag size and also your address. All right, guys, really appreciate it. Hopefully this was helpful. Tomorrow we will be talking about diagonals. All right. Everybody, have a wonderful day, and we will see you all tomorrow. Thank you as always.